Hi, Youngrok. Welcome to Venture with Grace today.
Hi, Grace. Good morning. Thanks for having me.
You have a very interesting experience before you started your career in investing. So you were originally from Korea, and then you have, studied computer science in Japan, well, in a band, and you have served in the military service in Iraq and worked as an engineer in Goldman Sachs Tokyo for 6 years and earned an MBA in University of Chicago. And to begin our podcast, I would love to for you to share with us your journey into venture.
Sure, sounds great. Thanks again for having me. So yes, my background is nothing fancy compared to all these, founder, VC background. But yes, I'm originally from Korea. I was really interested in Japanese pop music or J-rock, J-pop, whatever people call. Again, it was back in 2000, so 25 years ago. Back then, the J culture was a lot bigger than now. I mean, still the Japanese culture is very, very strong, but it was another level before. So I was heavily influenced by them, and I decided to go to Japan to play guitar in a band. I have been playing guitar in a band when I was in high school. So I went there, and but I also are interested in computer. So I decided to major computer science in college while pursuing my dream as a rock band. And all the Korean healthy male have to serve for military services for 2 years. Back then it was 2 years. I think it's shorter now. And then I was in army. I went back to Korea after 2 years in Japan. Served for army for 2 years, and during the time I had a chance to apply for uh, you know the the time in Iraq and or Afghanistan. I didn't make it to Afghanistan, but I made it to Iraq, and I was spending 7 months there from 2005 to 2006, right after the war is over. And that makes me really think like, oh wow, like the world is a lot bigger than like Korea, Japan, and I really want to work for a global company where I can see this global setting, more people, diversified views. Because when I was in Iraq, I met Japanese army, or not army, but self guard teams, U.S. Army, UK Army, Fiji Army, all those stuff, right? And it was just fascinating, right? So and at the same time I realized, okay, I'm not probably that talented as a guitar player, and I gave up my dream as a rock band musician, but decided to pursue computer engineer in a global company. And in Japan there's not many really options you can choose when it comes to global working environment. It can be global tech companies. But still, back then, Google I was recruiting around 2007, 8. So the Google was just right after Google came into Japan. So it was a very small office, and they didn't even hire people without master degree back then. And I didn't have a master back then, so I couldn't even apply for companies like Google. So there and at the same time, investment banks are great options to work in Japan. Even if you're in Japan, you don't feel like you're in Japan because the setup is so global. And if any of audiences here is interested in working or living in Japan but don't speak Japanese, uh, investment banks in Japan is could be a good option. Um, and then I was there. It was really good experience. 6 years, as you said. Um, but at the same time, the Tokyo office is the third, I think, the largest office after U.S. and in UK office, or third, well, fourth, and if between Hong Kong, Japan, UK, and US. All the major decisions are made in the US after all, because headquarters is in New York, right? Um, and at the same time, it was around 2009, 2015, where all these venture capital or startups in start burgeoning, right, in the US and Silicon Valley. So I wanted to try, you know, challenge my challenges in the US. And as a foreigner, one of the easiest way to go to the US is to go to school, right?
Mhm.
Um, and I don't have any visa. I never lived in the US. I visited US only once before I moved to the US for my, after Goldman. So I applied for MBA, and University of Chicago was one of my top choices, and luckily I got it. So it was 2015, and I decided to explore both startup and VC. And one of the beauty of being an MBA student is to allow all the students try everything, right? So I tried a startup, like school setting setup type of the venture. We I think we got even grant from school, but we decided to return the money back because we decided not to pursue it. But at the same time, I got a job opportunity at Arch Venture Partners, which is one of the largest now deep tech life science VC shop, headquartered in Chicago. A lot of not many people know about what Arch stands for. People think of like this Arch, but actually Arch stands for. So Arch is it started as helping the commercialization of the deep tech. And one of the famous and notable lab in Chicago is Argonne, research lab. And so R stands for AR stands for Argonne, and CH is stands for Chicago. So it's a very simple like Argonne, Chicago. So that's why how the Arch the name came up. But anyways, I was there for 1 year, working as an associate, and it was really good experience for me to build the foundation as a VC. I was there from 2016 to 17 as an MBA part-time intern. I was there like I working 3 days a week, but it's pretty good, experience, right? And then I got a job as a full-time venture investor in the U.S. As part of the Recruit Holdings, one of the largest Japanese corporates, which is the parent company of Indeed and Glassdoor. And I had a chance to do both startup and fund investment. The startup investment was good, but I really find opportunity and joy in the fund investment, and ended up staying in the fund investment in the past what like 5 6 years.
Amazing. Wow, that's a really like a great rundown of your past career record. And
Thank you.
I thought, what I like, I'm just curious. Okay, so you have like when you first join your current company, how do you kind of like establish yourself with like the strategy of how we're gonna invest in, fund managers, and what were the I guess like what were the goals from the corporate venture arm at the beginning, and then how do you kind of position yourself to, you know, basically creating the strategy for the company? And also
Sure.
it's such a
I
new
think it's a
space.
good time to introduce.
Yeah, sorry,
Sure,
keep
sure.
going.
So I think it's a good. No, no, no worries. Thanks for the question. So I think that's a really important question and great question. So I think it's a time to explain and introduce who GREE, GREE is. So GREE is a Japanese public company in the gaming space. It's a small public company, but it has a strong brand. Everyone in Japan knows about the company. Um, Again, it's a gaming company, and a lot of people know the company as a gaming company. But at the same time, what people don't know about the company is their investment business. So it started as an investor around 14 years ago. So he started investing funds, and then he started investing startups. And now GREE actually became one of the largest fund of fund in Japan. So they pretty much invest in all the top tier venture firms, firms and funds in Japan. Now I think they have more than 50, 60, 50 managers and 80 funds that with more than I think it to $300 million UM. And I mean in the US $300 million UM is nothing, but well not nothing, but it's not necessarily the largest, but given the size of the market in Japan, that's pretty much really, really big, right? So they build a reputation as an investor in the venture community, and now they more importantly they made a good fortune out of those investments. And they wanted to expand their fund of fund investment exercise practice outside of Japan, and it was around 2021. Around the time, I was actually raising my own fund of fund because I was really into fund of funds. I quit my previous job at Recruit, and I was raising my own fund of fund. And I think some people ask me like, "Hey, like, what about this company called Rich on my LinkedIn?" And actually, Rich is the name of the fund of fund that I was trying to raise initially. And GREE was one of my prospective LPs initially, and I show up asking for money without knowing their plan to outside of the Japan. And it turned out they were about to go abroad, and they offered me a job to join them instead of me raising my own fund. um, so after all the conversation, they also like start evaluating it seriously, and I also evaluate this opportunity, comparing pros and cons between me raising small fund or me joining the bigger platform. And then and I chose the latter. So that's how. So to answer your question, so I didn't need to navigate after I joined the firm because it was on from the onset. It was the part of the conversation doing emerging major fund of fund. Um, Agreed.
Mm. I wonder, how do you convince the team to give you a certain amount of asset? And then what was a picture that you paint for the LP to like envision how this could be beneficial for them? Or yeah.
Sure. So again, I think everything requires luck, as we know, right?
Mhm.
Um, so for Gree, there's a I got really lucky in terms of the timing because again they were about to start U.S. Fund of Fund, and they were looking for someone who can lead their practice, right? At the same time, what that means is they already allocated some capital internally to run this business, right?
Mhm.
So I didn't need to persuade them, hey, I need this amount of money to run this business, right? Because they
Mhm.
already have the budget, right?
Mhm.
In fact, I was trying to raise a $10 million fund of fund, like proof of concept, like 5 to 10,
Mhm.
like any other emerging majors, right?
Mhm.
And the budget they secure for this new initiative is a lot bigger than those 5 to 10, right? So
Mhm.
for me, it was big enough to prove out and test it out my investment strategy, right? So I
Mhm.
didn't really need to again convince them to allocate a certain amount of the capital. Now,
Mhm.
what I tried to convince them was emerging major part. At the beginning, they were not really familiar with emerging majors. What they wanted to do is this traditional like fund of fund model, top
Mhm.
tier big brands, small number of those investment, right? But
Mhm.
I try to persuade them why emerging majors are interesting, why there is a why emerging major is the asset classes that we can capture the alpha beyond on top of the along with those top tier VC firms. And I mean we had a series of conversation with all different type of a layer level of the execs, and we decided to do both actually. So we decided to do both emerging as well as established majors. And now looking back, I think it was a good decision because by nature, emerging majors high risk high return. Once they are successful, they're really successful, right?
Mhm.
Established majors, I mean, I have invested in big firms even when I was in Recruit, right? So I know how they perform. So they are very stable, very good, very strong, good enough return profile, right? So I think I turned out win-win for both me and Recruit.
Mm. Why do you feel like manager was a really undervalued asset?
First of all, I didn't say undervalued. I think
Mhm.
it's now I think a lot of more people start realizing, how interesting, how attractive the asset class is. But I think the problem is people just don't know, right?
Mm-hmm.
And well, two things: people don't know, and two, even if they know it, it's just hard because, Grace, how many emerging majors you know? Maybe 100, 200, 300, even more than that, right? Because there's so many emerging majors. So if there is some people, hey, I'm gonna spend an hour or two every week to invest in emerging majors, I think that's really, really difficult because there's so many. Um, for me, I started my career as an engineer at Goldman, which means I have some familiarity in the fintech space or engineering in the financial industries, right? When I got my job at Recruit Holdings back in 2017, it's the year, as you know, the first crypto boom happened. So I was ahead of the blockchain investment as well at Recruit, actually. So that's actually where I had a chance to invest in emerging majors for the first time. Again, 2017 was the first crypto boom. 2018, you know, or 17, 18, 19, except like few, like two, three crypto funds, every single crypto funds were emerging majors, right? Because the market itself is new.
Mm-hmm.
So we decided to invest in some funds along with the startups because we wanted to learn from other majors as well, right? So we literally met like 30, 40. I still remember a chart that I created in a list of the 30, 40 crypto emerging, oh, not, I didn't call them emerging majors because everyone is emerging. 30,
Mm-hmm.
40 crypto funds. I met all
Mm-hmm.
of them and, made this comparison chart, like, who is good, who has a pros and cons. And then we chose two out of them and we invested in them. And it went really well. And one of them is a multi-coin capital,
Mm-hmm.
which is very, very well known, very successful crypto funds by now. But back then, they were already, quite successful, but not this level. They were still considered emerging majors, right? And then that makes me think like, oh wow, like how quickly those funds can grow in terms of their brand strength and actual return profile perspective, right? I mean, it's a crypto, it's a different game, but it was so fascinating how quickly they make money and build their brand, right? So that makes me think like, okay, I maybe it is happening outside of crypto as well, and that's why I decided to research some of the non-crypto emerging major space as well. And unsurprisingly, I learned it is happening non-crypto space as well, right? It's rare, but it happens, right? And someone gotta have some starting point anyway, right? Even Andreessen, they are like only 15 years old now. They're
Mm-hmm.
relatively younger than other, you know, Sequoia or Greylock, Bessemer, all those funds. But look at them, how quickly they grew up, right? And became one of the market dominant players. So that's how I was convinced by myself with why emerging measure could be interesting, and why there's opportunity.
Mm, I guess like since you guys have invested in over 60 different funds, how do you spend your time? Like would you say like let's say half of the fund are like more on the establishment or like but the other half are like more on the emerging manager. And how do you I guess like what's your portfolio construction? I don't know if you're comfortable sharing, but like you can also
Oh
just
yeah,
share about like your overall view too.
sure. I mean, first of all, I think we are we are actually internally discussing on this, but the information on the homepage is kind of you know it's not clear enough. So 60 or 70, whatever number there is combined number between U.S. operation and Japan operation,
Mm,
and that's even not up to date. So the actual number of funds that we back in the U.S. is much smaller than 60. We back around 20 funds now in the past 3 years,
mhm,
and roughly half of them are emerging majors and half of them are established majors by the dollar amount. Um,
mm,
so how we spend our time? So established majors, it's like it's a very similar. I started my venture capital career as startup investors, right? So I can compare that my fund investment experience to startup investment experience. So what are people? tell is what I tell people is um, it's very similar to startup, right? So established majors are like Series C, D, E companies, right? And they may not need my help that much because
Mhm.
they know how to run the company. They know how to run the show. I mean, they know a lot more than me for a lot of aspects, in fact, because they have
Mhm.
run this for 10, 20, even 30 years, right? So it's very their my time spending with them is very limited. Whenever I have a questions and need their help, I talk to them, and whenever they need my help and ask a question, they talk to them. It's like more ad hoc based, right? At the same time, emerging majors is a little bit different, right? And there's a lot of variance, right? So some emerging majors I talk to almost every month. Some emerging majors I talk like every quarter, or even less than every quarter, right? Depending on the needs, right? So emerging majors are somewhere is like more seed, pre-seed, seed, Series A companies where investors have to and want to involve it a little bit more. So I try to prioritize my more time on emerging majors, so I can help them to try to so I can find area there where I can be helpful to for them to graduate into established majors in the mid to longer term.
Mm, I guess okay. So, I wanted to quickly say hi to the audience. Hi, Hamaza. Hi, David. We're gonna address your questions at the end of the interview. Please stay tuned. Anyway, so I guess like when you're thinking about GP invest in startups, people always talk about like how do you source deal, how do you win, how do you like pick, how do you eventually exit, right? So as
Right,
for LPs, like when you are looking at emerging managers, how do you source? Like, do you wait until the I know that we chat about like you have maybe you chatted with like hundreds of like over like hundreds of people every year, right? So like
right.
I wonder like how do you source deal? Like, I guess, like, source the deal that you will eventually invest in. Would you hear them from, like, a warm intro, or would you, manually go after a certain deal? And how do you like, what are things that you would evaluate to pick this, fund? And if it's,
Hmm.
like, a competitive fund, how do you win this fund? Eventually, I guess, like, what does the exit look like for you as, like, a good outcome?
Right, right. So I think there's a multiple questions, right? The first question is sourcing. Again, I think it's very similar to startup investment. So the chance VC that invested in the deals that was called reached is
Mhm,
low, right? And the chance that they invest in the company when the deal was through the warm intro from someone they respect and trust, the chance is high, right? Is it very similar to that? So I mean, when it comes to fund, most of the funds, unless they choose the right legal structure, they cannot publicly solicit raising the capital, right? So it
mhm,
has to be some sort of intro anyway, right? Um, and I talk to what 120, 200 funds every single year. Every single thing is well, not everything. More than 99% is through the intro, right? Is
mhm.
whether light intro, warm intro, intro from someone I really admire. But looking back, I think the investment we have made is most of the investment were through the people we trust and work closely. So again, very similar to the startup investment, right? So I have a
Mhm,
group of people I catch up a lot, exchange notes. So again, it's very similar to the startup investment. I have friends in the fund of fund, family office, things like that, right? So who are looking at the similar space. So we exchange notes all the time. So and those are the people usually share interesting deals the most. So that's how I source the deals usually. Sometimes I talk to the people who cold reach out to me, but I think as it was we never invested in any funds. I mean, we couldn't build our conviction to those funds that who could reach out to us just yet. we'll see. But we try to talk to everyone who were reaching out to us. Yeah, and
Mm,
then you know how to win the deals is, so I think one of the specialty. Well, first of all, I think this is something I tell other people as well, and which is if you, I mean, Grace, you wrote the book How to VC to be a VC what back in 2017, and if you going if you like going back in 2016, probably the year that you were writing the book, the VC environments are very different from now, right?
mhm.
And probably you can agree with that. But back then, 2015, 16, the VC, the power balance between VC and startup founder is, more like VC is here, higher, and the startup founder is a little bit lower, right? So always VC has more, I don't know, more power in the room, um, which now changing, right? I think now a lot of founders have more power. VC have to back their allocation if the founders are good, right? And the power balance is more. Still, I think it's just, there's some other similarity, but now it's more balanced, in my opinion. And now I think it's a similar thing is going to happen to GP and LP relationship as well. Now, especially now, because fundraising environment is really, really tough, LP has more say or power or leverage than GP. But I think it's a matter of time as the market recovers, the power balance is more balanced. So GPLP is a little more tight. So I think it's really important for LP or fund of fund like us to become value add LP. And that's what we are trying to do. So we try to be helpful as much as helpful to our portfolio fund. So, uh, you know, so we can stay and improve ourselves as a more of a value add LPs. And that's eventually, the way to win the allocation and the deal. So again, very similar to startup investment, right? I think I hope I hope I answer your question, but I think the last question you asked it was the expectation on the return. So the reason why we are interested in emerging managers is because it's high risk, high return. So we look for fund managers who have greatest potential to make like 5, 6, 7, or even 10x return. I understand it's still very difficult even for the emerging managers, even for the smaller funds. But I think it's probability wise, there are some funds who achieve that level of return. I have seen it. And in crypto space, obviously, I have seen a lot, um, including our own investment, right? So they're all double digit. And yeah, so try to find those funds who can potentially make a high return than they can get from the established majors.
I think so I have a couple questions there. I think one of the observation I had was
Hmm.
when you mentioned about like 2016 or 2017. I think
Hmm.
even like from the past to now, I think one of the things I've observed is like, the hottest deal always
Right,
are chased by the top investors.
managers. Yeah,
And I think it's like kind of like there's a two spectrum, right? And then there's like a lot of random like or some of them are a good deal, but like it's being like overlooked or something. But
yeah,
every other deal, everybody is chasing the investor, but the investors
yeah.
are chasing the top like 10 deal of the year kind of.
Right.
So I don't know if this is happening in the emerging VC market because maybe right now it's such a early stage that like everybody
Hmm.
have a non-proven track record as raising money
Hmm.
itself as a really high bar for people to do. Like for a company, maybe you will have a prototype that like investors or like people will be able to just like um have like a they can just see your product. But as for emerging managers, since like everybody is new, unless you left a really prestigious fund to start something, I assume that's like assuming those are the investors that everybody else chase.
Right.
I wonder if it's the same case with like the emerging manager market. Like, do LP chase like the 5 fund manager that left XYZ fund, or like does that just like not happening?
Right, right, right. I mean, I think there's a 2 points that I want to mention, right? First, yes, you're right. It's even 10 years ago, right? It's the hottest startups are always being chased, right? But the point that I wanted to make was, yes, it's always happening, but I think the level is more the heavy, severe, right? So it's
Mm,
now even same people. Let's say it's the same people, but it's now is they're hotter than like 10 years ago, right? And let's say there are only top 10% being chased, but now I think top 30% are being chased, right? So more that's why I said is the power balance is more balanced. It's not so the founders are higher. And to your second point about the emerging managers, whether it's the same, right? I think one of the misconception people have when they hear emerging major is, I mean, often emerging majors are not the first investors, right? So we
mm,
never, we have one exception, but except that one, we never invested in emerging majors without any prior investment background, track record,
mm,
right? Meaning we always try to find someone who can, even if the first one, we don't shy away from the first one, single GP, but we try to find they have to have something to show, right?
mm,
From the previous experience, right? And from my experience, those very attractive managers, even if they are first fund, they are being chased. It's not like a start investment, right? So it's not about like LP giving whatever money. It's not like that. It's a lot mild, obviously, but
mhm,
it's more competitive, right?
mhm,
Than other emerging majors. So
mm,
even now, when everyone is struggling, raising the capital, let's say typically it takes like 12 months, 18 months for emerging majors like to raise the capital. But those top, you know, so-called like hot emerging majors, it's a lot shorter, right?
mm,
3 months, 6 months, right? And that alone, and a lot of LP takes time to complete their due diligence as they get bigger, right? Even us, it takes our at least like 2 3 months. Um, And if they're raising only 6 months, that means if we got to know the managers, unless we got to know the managers at the beginning, like we don't really have time to complete our due diligence. We cannot make investment. We don't. I don't want to make investment without completing our due diligence, right? Which is another difference
mhm.
between the startup. So yes, I think it's a similar things that's happening for the emerging managers as well.
I wonder what is your like, I guess like we also miss like a subject that's about picking. So there is, let's say you met like 200 emerging managers. Like how do you come up with the conclusion of the 5 people or like 10 people that you would invest that year? And a like what kind of qualification do they have to have? And then number two is like how do you do due diligence? And like throughout, let's say the 6 month observing process, like what how do you kind of like leverage your time and connection into um, vetting a particular fund manager?
Yeah, that's another good question. So from my experience as a startup investment, right? Big difference between startup investment and fund investment is that when it comes to startup investment, Grace, as you said, like top 10, 20% founders are always being chased, right? Which means like bottom, I don't want to say the bottom, but like the other 50 or 60% of the founders, all the GP like VCs make a quite quick decision. In the often like first 5 minutes, 10 minutes, they just know it's not a good deal, right? Because and partially that is because the spectrum of the founders, the caliber of a spectrum of the founders is very wide, right? However, when it comes to fund managers, not like all the fund managers achieve something.
Mhm,
Otherwise, they are not going to start a fund, right? They achieve something as an operator, something as an investor, something as a founder. So they have something always, not always like more than 9%, right?
mhm,
Um, which means if you take a look at the deck, it's really often hard to tell like who's good. So that's why
mhm,
I always try to talk to them. Um, right? And even if you talk to them like in the first 5, 10, or 15 minutes, um, let's say like, you know, there's a fund manager A and B, both say, hey, I have a good network. I have a like whatever network. I mean, how are you gonna find whose network is better, right? And maybe both are great. Maybe someone has a little slightly better, but what do you mean by like better, right?
Mhm.
So there's a lot of these nuance, right? And you cannot figure out in a first like 5, 10, 20 minutes conversation, right? Unless there's a something completely off from our own mandate. For example, we don't invest in European funds, right? If there are European funds, like it's quick no, right? But otherwise, it's difficult, right? So I always use this expression when it comes to fund manager. Is like 70-80% of the fund managers are really good. They're good at presenting themselves. Their investment strategy looks really good. But my job is to find the best fit among those good managers, right? So
Mm.
that's why we have this pipeline process. So once we enjoy the conversation from the like first 30 minutes, 40 minutes, and then we put that into the pipeline. And we don't really do nothing. We don't try to get to know the managers, not necessarily. What we
Mm.
do instead is, so we have a bunch of opportunities in the pipeline, right? And we try to find the one that we most, liked among the pipeline, and spend a little more time to learn about them. Um, so so it is not. I'm not sure whether I deliver. I'm saying what I'm trying to say correctly, but it's not about the filtering out the bad one, but it's about the find the better one among the good one in the pipeline. And we consistently doing that. That means, and one thing we try to do is we try to avoid the vintage risk, which means we try to diversify all the investment through the all different type of vintages, right? Which means, let's say we in this quarter, for example, we had like 10 investment opportunities in the pipeline, and we chose to dig into 3 of them, right? And we decided to invest in 1 out of them. And then that's done. That pipeline is done. In the next quarter, we have another 10, and we made a decision to invest it in another one, right? But if we combine all the pipeline, maybe the one that we passed in the first quarter is maybe they're better than the one that we chose in the second quarter. But that happens, and we'll find that even if that happens, because that's our way to avoid our vintage risk. Um, so in short, we try to find the best opportunity in the given time frame, um, with our pipeline process. Does it make sense?
Mm. Um, for the audience who may not be familiar with like how LP invests, like would you mind to like elaborate more about like that what is a basically what is the outcome that you're trying to achieve to, how you kind of created this pipeline to to achieve that outcome?
Sure. Yeah. So again, the outcome what we are looking for is, you know, um, the maximize our return of our own
Mm,
fund,
of
right?
course, yeah.
Yeah. So, and in order to achieve that, we have to find the managers, from the emerging managers, right? Who can
Um,
outperform others. So that's what we are looking for, as an outcome.
I want to add, like, one of the audience, David, is asking, what is a good enough return profile for established versus emerging, and how do your expectation differ by font size? I think this is a good question, so and
So
relevant to what
for
we're doing, so.
yeah, so for the established majors is, I mean, I mean, David, if you had a chance to take a look at the benchmark, it's
Mhm.
so obvious that the multiple is very different by vintage, right? For the established majors, they all have their track record, right, from the prior funds. So we try to find. So first of all, short answer, we don't have like, hey, if the fund achieved 3x, that's like check the box, right? We don't have that kind of things. We try to
Mhm.
find the vintage, right, and private funds, compare the private fund performance to the benchmark by vintage, and if it is like median or top quartile or top decile, that's how we know, whether the sales managers are doing great, good, or bad, right? So it's quite easy. Obviously, there's a lot of these small details, how we interpret the benchmark, how we interpret their performance data, because there's a lot of questions about how do they value their own, portfolio company, et cetera, right? But it's like in a nutshell, we use their performance and benchmark and compare that, and see whether it's good enough return for each of those measures, right? On the other hand, emerging majors is there's no benchmark, right? Per fund, but again, it's there's two things we do. There's multiple things, but the two things I can share is, one is, again, we don't invest it in the funds without any investment track record, right? Even if they're emerging majors, they have some track record. It's like some people have like small, some people have a lot, right? That means we can also map out that performance into the benchmark data, right? If they made a 3 investment back in 2017, 5 investment back in 2018, we try to see whether that maps into the benchmark. Obviously, there's a lot of work has to be done, because let's say this guy is investing pre-seed and seed, but the investment they made in 2017 is like Series B, we don't count them, right? Because it is not the same strategy. But after we clean up those things, we try to find where they are in terms of benchmark. Let's compare the benchmark, like general universe of the benchmark. Second thing is, again, the one thing we have, we have is data from all the emerging managers that we meet, right? So we see the peer comparison. If you meet 100, 200 fund every year, you know where you get the data, right? So we have our own database where we manage. I mean, some of the data is still because we got the data from manager last year, right? Then it's already 1 year old, and in the VC performance, 1 year old data is, I don't know, it's just different, right? We cannot just use that to compare the performance data today, because it is not up to date. But we have our own system to make up that, and to make it set the level play ground. Um, so in short, we compare, let's say, fund A to other funds that we meet and see where they are. And we don't use the multiple, but we use different, data points. But that's how. There's a second point where we try to find where these emerging majors are located and compared to other emerging majors.
Mm, I want to piggyback on that question. Like, what are
Sure.
some benchmark do you use? Let's say you mentioned like you use multiple data points. Like, what does that entail?
I mean, like easiest answer, like so obvious one is co-investor,
Mm,
right? How many? I mean, when you say co-investment, there's a multiple ways to interpret them. First, if the deal is co-invested by top tier VC in the same round, right? What does it tell? That tells the guy won the location, right?
mhm,
Competing to other, even if there are like top tier VCs, which is good. So it's the indication of the winning capability, right?
mm,
Unless it is like $1,000 check or $10,000 check. If it is like that small, we don't count them. But it's like, okay size like 100K or 200K, we count them, right? Okay, these fund managers won the location in this very competitive or crowd, right? So that's winning again. Another one is who follow on investor, right, to the same company. So let's say it's fine even if there's no top tier VC in the same round. But what if 80% of deals are followed by one of those top tier VCs? That's peaking, right? That's peaking and probably sourcing as well. So that's one of those easy way, and I think a lot of LPs are doing that too, to find out, the capability of the sourcing, winning, delegating, supporting type of aspects of the emerging majors.
um, I keep seeing, like, on social media, there are a lot of, people investing in emerging manager, they don't like the fact that people pick the same company that are because of like XYZ fund is like investing. And I feel like it's kind of going against like the first point, which is like, who is your co-investor, right? Like people wants to see like you co-investment with like the top tier firm. But on the other hand, when you co-invest with top tier firm, people think you don't have the judgment ability to judge for yourself. I
Yeah.
wonder what's your thought on like when people come to when like you're reading these like advice or something on the internet. If like
Yeah.
how
No,
do
I
you
mean, first of all,
this?
I 200% agree with what the people said. We don't invest in the fund who say, hey, we are going to rely on other funds for due diligence. That's a red flag. We don't invest in them. So, um, but we prefer, actually, you know what? Let me take back. So, one of the mandates we have in investment strategies, we only invest in pre-seed seed funds. So, all listed stages fund, right? So, that means I look for managers who can find the companies or founders faster than anyone else. So we try to find how they do that, right? So, so the good example of that is Adam Besvinik, Looking Glass Capital is one of our portfolio funds. We back his first fund and second funds, and his fund size is not massive, right? His fund is not necessarily big enough to like so-called lead. But what he does is he acts like a lead investor. So he's the one who finds the company usually, the deal first, and he say yes to the founders, and he's try to find other lead investors and syndicates for the company. At the same time, I mean, like a lot of these, I know a lot of VCs say no or ask founders to come back to them once they found the lead, right? I think we don't invest in VCs like that. So again, people like Adam, and there's a lot more. There's a more increasing number of VCs like Adam these days, right? So we really like that kind of aspect who have ability to evaluate the founders and companies, and who have ability to build the conviction on their judgment, and who is the people who have the ability to syndicate the round because the the fund itself doesn't have the largest pool of capital to fill out the round, right? Um, and I think that's a good sign. And another example is Joe Wilson, another fund manager that we invested in first and second fund. He's the one too. Like his fund is not the largest, right? So $50 million funds, but he has access to all these founders in the deep tech space, and he found them first and say yes, and he tried to build the syndicate for them, build the conviction for those investors, things like that. So, long answer, sorry, but short to answer your question earlier, we don't invest in the fund manager who say we invest in the company because whatever Anderson invested, Sequoia invested. We don't invest in funds like that. Yeah.
Um, I wonder when they are doing due diligence, since they are technically like likely to be smaller funds, that's why they're not leading. First of all, like why wouldn't they leading? Wouldn't they be leading since like they are like since they're able to find these really attractive deals? Why wouldn't they want to just be the lead investor? And number two is like, um, when you're observing these fund managers forming conviction, um what does their due diligence process look like, since they have maybe less amount of resources compared to some of the bigger funds?
Sure. The first question is around why they don't lead, right? I mean, Grace, let me ask a question. What do you mean by lead? I think that the lead has a many different the definitions. I guess. What do you think is the lead?
I think you have to have enough conviction, enough capital, and also maybe adding enough value to be the lead investor. Well, technically, like you also hear, like especially in the seed, like pre-seed or seed. I feel like lead investor typically sometimes it's just like one investor.
Right,
So
right, right, right.
so I wonder what's your like I would love to learn from you.
Yeah, I mean, I think that's a really great point. So, but typically, I think that when people say lead, is the investors who set the terms, right?
Right.
The
Yeah.
amount of the capital they raise, valuation, all these and other terms, right? But what if, let's say, Adam, let's go back to our investment, right? What if he set the term for the founders, but not necessarily the largest check? Can we consider still him as a lead investor? Maybe yes, maybe no, right? So again, that's why I use the expression acting like a lead, right? So there are
So
some emerging majors like Adam who are acting like a lead, but actual legal document perspective, it's done by someone else, right? But he has a strong influence in terms of the setting the terms with the founders because he's the one who founded the company first, right? So usually, the investors who write the biggest check, set the terms, and write a legal documents, if that's the definition of being lead, small investors because they don't have, you know, the capital they need, they cannot lead. But again, if we broaden the definition of the being lead to, acting like a lead, I mean, there's a lot of emerging majors who lead the deals.
mm, I wonder when you're looking at like, right now there's a lot of emerging managers. They are
Hmm.
kind of acting um like a more established like professional like people who scout these deals. um like what as a like I guess like how does their fund evolve into the second generation? Would you say like most emerging manager are gonna merge into with each other, kind of like merge into a big fund? Or like would you say like, there's I know that you said in an interview said like there's like two train of investors, right? Like one train of investor trying to build like a X and Z or something. And the
Right,
other
right,
train of
right,
investor who are trying to keep going small and like, keep the team like just like by themselves, but like make great investments. I wonder like when we were just chatting about like let's say the if an investor set the terms, find the deal, but like not may not be like the person writing the biggest check or something like
right.
um I feel like it's kind of like a larger version of a skill, like scout to a degree. I wonder like what's your thought on like the fund, like where do you think the fund is gonna go in the future? And what do you think it would be like a benefit and challenges in that direction?
I think you already mentioned about the trends that I mentioned someone else, right?
Yeah.
Either try to become a platform or stay small, right?
Mhm.
And I think I really truly believe that's gonna continue to happen. Um, I mean, let's think about it like why there are more emerging majors. People start realizing even if the fund size is small, they can make a good portion. Let's say like $20 million funds. I'm not gonna say who, but this is actually some other emerging majors told me, who left a big platform. And I asked him like, hey, why did you leave, right? And then it's a good platform, right? And he built a good reputation up and there. And his answer is like, I can still build a good economics, right? Let's say it's $20 million first fund, 60 if even if it's like, well, let's say make about like 3x return, right? At the end of the day, $40 million profit, and it's a single GP. 20% of the 40 million is $8 million, right? So quite big, good, return. $8 million for himself, right, or herself. Now we're only talking about first fund. 2 years later, 2.5 years later, they're gonna start like second fund, $30 million maybe, another 8, 9, $10 million. Another 2, 3 years later, maybe another $30 million, another 8, 9, $10 million. Again, it's not small money. They're not gonna be billionaire, but it's good amount, good enough to build their own fortune, right?
Mhm.
So that's why they don't need to. They may not want to, you know, grow as AUM because fundraising takes long time, as we all know, right?
Mhm.
and they're happy being active lead or being follower, but still enjoying working with these all these stages of the founders, young, hungry founders, to make a fortune. So that's another reason why we believe, stay small. The funds who want to stay small is going to continue to exist going forward.
Mm. I have like two, like I have one real question, and then the audience. I saw one of the audience questions good. Like I don't know how long you have. I'll try
Sure. I
to
mean, yeah,
share.
like let's oh, it's already 10. Okay, let's have one 5 more minutes.
Okay, thank you. Okay, so
Thank you.
thank you. So one of my questions is like, as an LP, who do you consider is like an LP that you idolized? And how do you kind of build a network with other family offices or LPs? Um, like in reality, like in from like the technical perspective, like uh who do you I guess like what kind of conference would you go, and what kind of people, how do you kind of like network within that industry, since it's kind of an opaque industry, as you don't typically find everybody on every podcast or in every conference.
Yeah, you're right, and not everyone, is vocal on the social media, right? Um, I think a lot of these good connections that I have made is again through the intro, right? So we
Mhm,
are looking at the same type of emerging managers in the same space, and GPs make a connections, while other LPs make a connections, right? Hey, so and so is looking at the similar fund, like why don't you guys connect, right? So I think that's the way I met a lot of those funds that I exchanged the notes. I met some good people through the conference, but conference is not. I mean, for example, I never been to Super Return, right?
mhm,
I'm a huge fan of like conference called ABCJ in Asia, but I don't go to many conferences anyway. One,
mhm,
in terms of deal sourcing, again, I don't need to source the deals in this setup. Two, making peer connections. I mean, it's just Wild West usually, right? So I
mhm,
still go to those kind of conferences, right? But not like every month, maybe a few times a year, right?
mhm.
Yeah.
um So one of the audience questions, I will keep this short. What are your thoughts
Sure.
on thematic investors and your portfolio construction? Are you looking for a concentrated exposure?
So, short answer is first of all, we prefer fund managers with some thematic approach, but not too narrow. Again, we are investing pre seed, and the companies that they're going to invest it in is going to become a thing like 7 years later, right? So like how do we know, like for example, B2B SaaS in whatever industries is going to become a thing like 5 to 6 7 years, right? There's a really great article from USB University of Ventures, I think recently, and I think the the summary of the article is we have to make investment into weird things, and I completely resonated. I mean, think about like Airbnb, Uber, right? Uber is fine, but Airbnb, I thought myself like back in 2014, I'm not gonna never stay in someone else's place, because I thought that's so weird. Now I'm a huge fan of Airbnb. I still use, although like a fee and a clink is ridiculously expensive, I still use it because it's so convenient, right? So I think that kind of the crazy weird idea is I think I think a type of the venture investment is supposed to be, right? Now, going back to thematic approach, so that's why I want a little broader thematic. I want to have a thematic approach, but a little broader mandate, because I think that the broadness allow the managers to capture those weird, unusual opportunities. But at the same time, having some thematic expertise helps them to navigate within this broader, you know, industries or sectors, right? And yes, so I hope that answers the question.
Mm. Okay, so we have a 1 minute fire round for you. What's your favorite
Sure.
book?
Ooh, that's a good question. I don't read many books actually. I listen to a lot of podcasts. and read a lot of blogs. Yeah,
What is the most recent blog you have read?
again, the USB was a really good one, and it's not a blog, but there's the article, interview article by the information, interview to the Vinod Khosla. He
Mm,
was talking about how audio can change the technology and interaction that we have today. I mean, Kosa invested in this rabbit, the humane type of the device, right?
mhm.
So that's why
Yeah.
he talks about the technology. But again, I think it's a similar to USB article, like a crazy idea. I actually in a waiting line for the rabbit because I also thought like that's crazy. So yeah, I think those are the some articles and blogs that I find really interesting. Oh, and there's a article a blog article from NFX. It's written by Morgan. The article is about like AI is like a water. I highly recommend reading it. And there's another NFX article written by Pete, which is another really great article about AI.
Mm. Uh, who made the biggest impact in your career?
I would say it's my dad, because first of all, like the reason why I first interested in Japanese rock music was because my dad speaks Japanese. So he took me to
Mm,
Japan when he was traveling. He's running his own company, like a small medium company. So he has a flexibility to bring his kid to business trip to Japan, right? So
mhm.
whenever he go to the business trip in Japan, he took me like along with his own employees, right? Which looking back is so weird. But it's a small company, right? It's like I still know all those people. So yes, if he didn't take me to the Japan, the beginning, I think I didn't build this interest in Japanese rock music, and then you know nothing really happened what I done now.
Mm, mm. Who would you invite to your dinner party?
Ooh, I mean, just like I recently hang out with a lot of these founders, but we don't really talk about the work, which is really funny. I one of my close friends who just he's like YC what 2012 OG YC. He's the Gary Tang was the mentor to him. He
Mhm.
just recently sold the company to other bigger company, so we hang out a lot, and we don't talk about like necessarily hey emerging majors like that. We see landscapes like that, but I share what I see, and he share what I see as a founder. And he has a similar background. He's Taiwanese American who spent good amount of time in Japan, so it's culture similarity, and but in broader sort of ecosystem with a different view and experience. So yeah, I'm gonna invite him. Actually, I should invite him for dinner in terms of so yeah.
Amazing. Where can we find you outside of work?
I have a kid, daughter, 19-month-old daughter. So I spend a lot of time with her lately. Over the weekend, I love outdoor, so I do the camping with her. Well, my wife as well. Hiking. I mean, that's one of the luxury that we have living in the Bay Area, right, Grace?
Mhm.
So that's
Yeah, for
how
sure.
we spend that. Yeah.
That's amazing. Well, thank you so much, Youngrok, for coming onto the show today.
Thank you so much, Grace, for having me. It's just such an honor to be a part of the show.